Losing money in crypto happens all the time, but you need to consider this the cost of tuition. And it's okay to lose money from time to time. But the biggest mistake that you can make is not learning from your mistakes. Whether you're flipping JPEGs, aping into the next yield farming Ponzi, or flipping altcoins, crypto offers you many different teaching points. I want to give you guys 4 different lessons in crypto that have really stuck with me. The very first one that hits home is taking profits. I know this is simple to say, but if you aren't taking profits, you aren't collaring any wins. If you just ride these coins out, about 99.99999999999% of them are going to go to zero. Do you want to be the bag holder? Now also keep in mind, especially when you get into crypto, into some of these altcoins early, you can make multiple X's, and 100 to 1000X is actually not unheard of. There's several different meme coins that have done this and several different blue cap coins that we know of today. An example is like Aave, Polygon, Binance Coin, Solana, Luna, just to name a few. If we held to that thesis that this coin is going to the moon and never took profits, just imagine how you'd feel if you rode it all the way up to 250, or even bought Solana at 250 and rode it all the way back down to around $32, which are today's current prices. Another example of this would be DeFi Kingdoms. DeFi Kingdoms, it was going $5, $10, $15, $20. It was unstoppable. It was going to be the next best thing since sliced bread. Well, it's 18 cents now. Now, I'm not trying to say anything bad about these protocols. In fact, I still really like DeFi Kingdoms and I like the gameplay. But when you get into a bull market in an overhyped scenario, you have these valuations that get way overvalued. And the opposite is true. In a bear market, you actually get some assets that will be undervalued. Now, time will tell. We'll see what happens if these assets are currently undervalued. But again, the point is take profits. If you were holding Jewel and you rode it all the way up to $20, you would feel really great if you just took profits at $20, $10, or even $5 compared to current prices. And the same is true for Solana. The biggest thing to understand with these protocols, especially in cryptocurrency, is that the market cap is almost a meme. Let me give an example of this. There's 10 different investors. They all invest $1,000 into this new altcoin. They throw it into this altcoin. This altcoin has 1,000% staking returns for the entire year. Well, we all invested $1,000 a piece. So that total market cap of that coin should be $10,000, correct? Because that's all the money invested? Well, no, that's not the case. At the end of the year, with the 1,000% staking returns, the market cap would end up being $110,000. So let me explain how this would work. If each investor invested $1,000 and they each got one coin and they staked that one coin to get the 1,000% APR, at the end of the year, they would each have 11 coins. If each coin initially was $1,000 and at the end of the year, each investor has 11 coins, remember there's 10. So we now have a total of 110 tokens with a valuation of $1,000 each coin. That gives us the $110,000 valuation. However, the liquidity is not there to sell the token. This is why you see these reflexive price pumps and price dumps with cryptocurrency. You may see a market cap that's there, but just because that market cap is there doesn't mean the liquidity is there to sell this. Now, the second lesson is FOMO. I remember seeing several different YouTube videos on a token called 1inch, especially around the airdrop that happened, where several users were actually given this token for free. I didn't understand this. I just heard that people were bullish on 1inch. It was the next best thing since sliced bread. It was aggregating different dexes and it was creating the best prices. And I was like, man, that is the best thing ever. I mean, just think about Amazon. Amazon gives the best prices. It's a major company. It's one of the biggest in the world. And I was thinking, 1inch has got to do the same thing. And instead of doing more research to understand the 1inch token, I just saw it going up. It was going from $3, $4 to $5 to $6. And then I was like, man, I need to buy this coin. And I bought around $5 and I thought I was doing really good. And as time went on, this chart played out. And obviously, if you look into the tokenomics of 1inch, there's not a big value capture mechanism for the 1inch token. And it was really given out for free for airdrops. And there are yet still additional tokens that need to be emitted. So this also causes negative price action on the token price. So taking the time to understand what a token is and what it does and its value capture mechanism is super important. And if you do have that FOMO, stop, take a shower, go to bed, go eat some food, come back a week later, research the token, and if you still have that conviction on the protocol, you can deploy some capital. But remember, don't invest more than you're willing to lose. Just because you have the conviction on it doesn't mean it's going to play out. So hedge yourself accordingly. The third lesson I want to share with you is don't marry your bags. This is pancake swap. I remember when it first came out, some YouTubers were talking about it, and it was like, yeah, you stake your cake to earn cake, and then stake that cake to earn more cake. And I'm like, wow, this is so cool. It's like so easy. You just stake, you earn cake, and it goes up. And it was great. It was going from 75 cents to $1 to $2, $3, $4. It just kept going up. And eventually it reached a peak around $42. And I became a cake maxi because I was like, man, this has made me a lot of money. I'm a huge fan. It will never go down. This is the best coin ever. Well, you can see what's playing out on the charts. And I remember telling my dad this story about the cake token and how you'd stake your cake to earn more cake and then stake to earn more cake again. And I made over 100x on my investment. He just stopped. He looked at me and he said, son, sell now. And of course, he doesn't really like this crypto thing anyways. He always tells me to sell all the time, but he made a really good point. He understood that I made multiple X's on my investment. And he was teaching me the lesson of take profits, collar your wins. If you don't collar the wins, the market's going to do it for you and someone else will take your wins. And yes, the good news of the story is I did listen to him. I didn't sell at the Pico top, but I sold some around $35. I sold some around $25, some around $15, and the rest was history. I do still hold a little bit of cake, but it's a residual amount, but I was able to collar the wins. Sure, I didn't get at the Pico top, but I got a significant amount of it. And after taking all those profits, the story doesn't end there. This is when Polygon was hitting the stage with its yield farming craze. This is when we had Polywhale. This is when we had QuickSwap, Iron Finance, DinoSwap, Aave looping strategy where you can basically get paid in order to borrow money, Adamant Finance, Polycat Finance, just to name a few. And if you go check out the site on DinoSwap, man, the TVL is only $185,000. I remember this thing when it was billions and billions in TVL locked, and the Dino price was actually in the dollars, not zero. It was worth almost $5 at one point, and now it's not even worth a penny. And the reason why this relates to don't marry your bags is because yield farming is a rotation game. Even in altcoins, liquidity will go from coin to coin to coin, or it will go from chain to chain to chain. If you marry your bags and I was like, hey, I'm staying on PancakeSwap, it would be down only. But rotating your gains from something like PancakeSwap on the Binance Smart Chain into something like Polygon, you would be able to make X's on your new additional X's. So if you made $100 into $1,000 and you now turn that $1,000 into $10,000 because you made a 10x on each time you multiply those 10x's, the gains compound. It's exponential growth, not linear growth. So that's something to keep in mind why you don't want to marry your bags, especially in crypto. And you need to understand, just because you have conviction or a thesis on something doesn't mean the market agrees with you. Yes, I get it. There's such thing as long-term plays, but especially in the yield farming game, a lot of these Ponzi coins, they're not in it for the long term. These are just zero-sum games where there are going to be winners, losers, and the devs, they always win because they typically get a cut of everything that happens on their protocol. Now, the fourth lesson I want to share with you guys is this time is different. History doesn't necessarily repeat, but it often rhymes. This is a tweet from Suzu. He was basically quoting and saying, this is the super cycle. I have massive conviction on this. This is going to be different. It's not going to be the 4-year cycles like we normally have. Now, Bitcoin history has proven to us that there's 4 different phases in the Bitcoin cycle that revolve around the Bitcoin halving. But that's not only related to crypto. This also relates to the actual markets themselves. But they aren't constricted to timeframes. People constrict the timeframes to Bitcoin with 4-year cycles because you have news and news moves the markets. The psychology of the market repeats so many times that they even made a chart for this. And there's 4 different phases in this. This doesn't only relate to Bitcoin, but this relates to several different asset classes. And you can see here, this is typically how it plays out. And if you put this chart over a Bitcoin chart or any stock chart, you can see it playing out just on different time zones. And the 4 different phases have to do with accumulation phase, the markup phase, the distribution phase, and the downtrend. The accumulation phase happens around here when nobody is active, nobody cares, YouTube subscribers are down, and people are like, this is junk, I don't like crypto, I never want to see it again. And after that accumulation phase, you start to see the markup. This happens around this stage. The market makers have already bought in the accumulation stage, but now they're ready to distribute to other users after the markup phase. The markup phase has happened, prices are high, now we're ready to distribute. All of retail and all users, they get FOMO, euphoria. Everyone's like, it's going to go to the moon, the super cycle. And this is when the market makers deploy and say, hey, look, we're selling now. So everything is sold on retail, and then you have the markdown phase, and then it replays over. So if you guys are still around for this bear market, remember, this is the accumulation phase. This happens with all assets. So you guys do with the information what you will. So in summary, the 4 different lessons I want to share with you guys is 1, take profits. 2, don't FOMO. It's not cool. Chill out, take a cold shower, go for a walk. 3, don't marry your bags. The crypto markets move, you need to rotate with them. 4, this time is different. It's usually not the case. History doesn't always repeat, but it often rhymes. I know it's not fun to lose money in the markets, but remember, the biggest mistake you can make is not learning from your mistakes. Just consider it the cost of tuition if you do lose money. Thanks for tuning in, guys. I hope you guys enjoyed this video. I'll be sharing some other DeFi strategies, what you guys can do in the markets, and different tokens that I'm looking at in the markets. I'm going to be here through this bear market. So if you guys want somewhere to stay comfy, I'll be here. Let's go ahead and hit you guys with a wisdom one-liner. Proverbs chapter 12, verses 25. Anxiety weighs down the heart, but kind words cheer it up. Don't be anxious. Be good. Be kind to each other. Peace.